Dividend investing, another exciting video. I'm going to answer 5 of your questions. So quick update, I just published a beginner's guide to dividend investing. I'll link to it in the description below. This comes by popular request. It's over 4,000 words. This comes by popular request because a lot of you guys are here new on PPC Ian wondering, where do I get started with dividend investing? Ian, you have all these videos, I don't know where to start. So the guide will help you. It's a written guide, 4,000 plus words. Talks about the basics of dividend investing, talks about this channel, what it's all about, and how to navigate the channel, where to get started, which videos to get started with. So check that out. I'm really proud of it. Link in the description below. Also, another update. Today, I'm a bit tired. It's been a long day. Got up at 5 a.m. this morning. We had a PPC Ian meetup in San Francisco from 8 a.m. through noon. It was a really productive meetup, really amazing. Love you guys. And so I'm doing the video now, but I'm a little tired. I'm especially tired though because I just filmed this video and I had technical difficulties, so I'm refilming it. So I hope you guys appreciate this dividend investing video. Your support, your likes, comments means the world to me. Now, I'm going to answer 5 dividend questions today, and so let's do it. And oh, by the way, one last thing, I'm going to share in the description below some of the stock tickers that I jotted down during our meeting this morning, our PPC Ian local San Francisco meetup. By the way, if you live in California or have plans to visit California, join our local Bay Area crew. I'll link in the description below so that you can join us. Sign up for that email list so you'll be aware of meetups and events that are happening. I had 2 friends today, 8 of us actually in total today. 2 of them, though, were visiting from out of the area. One all the way from the Philippines, and he brought his girlfriend. Thank you so much. Amazing. And then another one from Los Angeles. Thank you, my good friend from Los Angeles. And so people are visiting even from out of the area to enjoy these meetups. So I'm blessed. I love you guys. 8 of us today at the Starbucks Reserve in San Francisco. We had such a great time, and it's just a reflection, quite frankly, of this amazing community. So I'll put in the description below. We talked about stock picks, dividend stocks. I'll put the tickers of all the stocks we discussed in case others and even people to meet up want a copy, or they want to look into some of those stock picks on their own time. There's a long list of stocks that we discussed. So let's get started with today's dividend investing video. All right, everyone. So again, I'm filming this for the second time, so maybe it'll be quicker this time. We'll see. I'm going to try to be as streamlined as possible. Question 1. Hey, Ian, I have a question. Hopefully you can briefly answer here or perhaps do a video on it. What do you do when you bought shares of a dividend stock for the long term, but the stock is shot up so much that you're tempted to sell your shares and take capital gains profits off the table and try to buy back after the dip? Or would you just not worry about it and focus on dividends? Love this question. So I do own stocks right now that have skyrocketed. Some examples of those, I'm talking about stocks at 52-week highs, all-time highs, talking about stocks like McDonalds, Pepsi, talking about Coca-Cola, I'm talking about Realty Income. These guys are through the roof. I'm not here to sell stocks. I buy and hold forever. But what I do is I'm avoiding adding more capital to those companies right now at these high prices. I am reinvesting dividends. I don't want to penalize winners. Link in the description below. I just in my last video talked about that at length. And the key point here is just because a stock has gone up through the roof, it doesn't mean that it's going to come back down, quite frankly. These companies are world-class companies. Stocks that go up, they can keep going up. And so the way I look at it is I got a stock, it keeps going up, I'm just going to hold it, but I am going to wait for a hopeful eventual correction so that I can buy more shares. So right now, other than reinvesting dividends, I'm not buying more Realty Income, for example. Now let's contrast that though. I have a few other stocks in my portfolio that I believe right now are really good values. And so examples of those are Cedar Fair, 3M, and Leggett Platt. Those stocks are not trading at all-time highs. Those stocks have really good starting yields. And so the way I look at it is just when I'm allocating capital, I go towards value. I go towards value. And so if something's at an all-time high, I'm not going to sell it and then try to wait for the dip and buy it back, just because it's really hard to time the market. And I'm not in the game for market timing or capital appreciation. I'm in the game for the dividends. And as soon as I sell something, I don't have that dividend income. I don't have the dividend income, and I'm going to be paying capital gains taxes on my gains. And if some of those gains are from less than 1 year of holding, those are short-term capital gains. A link in the description below. I've done a video on taxes and dividend investing that's kind of related to this. And so because of kind of the tax side of it, because I can't, quite frankly, time the market, and so few people can, and also because I just don't want to sell and then I don't have that income anymore, I'm kind of at the point in my life where, we talked about this at the meetup a bit, I'm going to be tapping into this dividend income sooner or later to pay bills, start paying bills. And that's just where we're at. And we're going to need to. And so to sell kind of the favorite stocks that are doing really well, those are some of the ones that are generating the most raw dollars of dividends for me. And so I just, I don't want to do that. And so that's where I'm at with it. But I will be smart about deploying net new capital, and I'll kind of skew towards those stocks that are on sale. But I won't always do that. I'll also sometimes buy stocks even that are at fair valuations. For example, I was buying Pepsi earlier this year. It's a lot higher now than where I bought, but even earlier this year, people are wondering, Ian, why are you buying Pepsi here? It's not on sale. Well, it's just kind of an allocation thing. I wanted to have more in Pepsi because it's my number 2 favorite stock of all time. And so that's how I look at things. Now, everyone looks at it differently. My strategy is not the only strategy, but that's how I like to do it for my own portfolio. Good question. So, and one last thing on this. This is why I diversify. I diversify because out of my 40 stocks, there's always going to be some that have gone way up, and there's always going to be some that are fairly priced and some that are on discount. And out of my 40, I like to pick the ones that are on discount to add net new capital. And there's always 1 or 2 of them. Okay, next question. So what do you think of Kellogg? It's yielding 4% right now. All right, I love this one. So Kellogg's, they make food products, packaged foods. This goes back kind of to what I was talking about with Iron Mountain in my last video. If a stock I don't like, I'll just cross it off the list, even without looking into it too much more, because there's so many options out there, and it takes so long to analyze a company that I can just cross stuff off the list. And I can cross stuff off the list based on my kind of street knowledge, my thug life knowledge. And the street knowledge that I have with this sector is, look, Kellogg, I don't think they have the strongest portfolio. Let's just look at this. So Kellogg's portfolio. We got Special K. They got like Raisin Bran, Rice Krispies. It's a bunch of cereals. They got Pop-Tarts, and they've got Eggo waffles. I don't believe these are the strongest categories to be in. Maybe they're slightly better than what Kraft Heinz has. Putting aside Heinz. Heinz is a golden holding of Kraft Heinz. But Kellogg's not in the strongest categories, in my opinion. Contrast that with something like a General Mills that has Cheerios. Again, cereal, not that exciting, but what they have is the Annie's organic brands, golden. Also, they have the Blue Buffalo pet food acquisition, organic, golden. People are all about their pets these days, giving their pets the best possible organic foods. And they own Yoplait yogurts too, which I think is pretty good. Now, let's also look at another, so I own General Mills. Let's look at Campbell's Soup. Campbell's Soup owns the iconic Campbell's Soup. They bought Snyder's Lance, the pretzel company, snack foods company, golden. They own Pepperidge Farm, which owns the Milano cookies and the Goldfish, golden. They own Plum Organics, which is kind of like pouches and snack bars for toddlers and babies, golden. And so the way I look at this is when I just compare the companies at a high level, let's not even look at the yields. Who is the strongest portfolio? I don't know whose is quite the strongest, but I certainly don't think it's Kellogg's. And I feel better about the Campbell's Soup and the General Mills portfolios. And so that's where I skew. And I just put Kellogg's off the list just because of that. And I certainly don't want more companies in this category. I already own a bunch of them. And so let's look at the dividend yields, though. Kellogg's at 4.1%, General Mills 3.7%, Campbell's Soup 3.4%. So Kellogg's right now is the highest starting yield, but again, starting yield, dividend yield, it's not everything. There has to be a solid foundation. And I would say, without even looking at the financials, I believe that Campbell's Soup and General Mills, just through the strengths of their portfolios, have a stronger foundation than a Kellogg's, for example. And so that's kind of how I look at things and can quickly get things off the list It may not be for me. Now, I don't want to put down anyone in Kellogg's. If you're in Kellogg's, I wish you all the best. Huge success. I'm just talking about for my own personal situation. And the beauty of this stuff is there are different stocks for different people. And I'll tell you, right now, 2019, I'm not buying General Mills and Campbell's Soup other than reinvesting dividends. I was only doing this last year when they were on deep discount. And so the corollary to all of this is it goes back to my first point. These guys aren't hockey stick or anything, but they're trading very fairly now. They're not on discount. I'm not buying fair valuations on General Mills. I'm only buying that thing when it's on discount. And so goes back to the first point. I'm not going to sell it. I'm going to enjoy the dividends and reinvest the dividends, but certainly new capital is not going to go into this sector at this time when these stocks have already recovered. And so that is a very important nuance, ties into that first point from question number 1. Okay, moving on, I have question number 3. Okay. What are your thoughts on Fundrise? You invest in real estate properties through them. People that I know personally have been investing 1-2 years are averaging 8 to 12% returns. Okay, I love this. I've been waiting to talk about this for so long. I don't know about Fundrise, but I do have experience with a platform called Realty Mogul. Probably very similar. These are platforms online that allow everyday investors like you and me to buy shares of interests in commercial real estate properties, apartment buildings, for example. And so what these platforms typically offer are, hey, I'll give you an example. I almost invested in one of them. In Realty Mogul, they had a property here in Redwood City in prime real estate in the San Francisco Bay Area. And the idea was the sponsor of the project, hey, I'm going to raise some capital through Realty Mogul. We're going to buy the property, or they already had control of it, but we're going to revamp it. We're going to get the necessary loans, necessary capital. We're going to revamp it. We're going to raise rents. We're going to hold it for a while, probably 8 to 10 years, and then we're going to sell it for a profit. What's great about these platforms is they tell you exactly what they're going to do. They tell you the exact investment thesis. This is the plan. This is what we want to do. And basically, it's just not consistent with my philosophy. My philosophy is buy and hold forever because I want a huge yield on cost and I want cash flow. I don't care about capital appreciation other than it being a reflection of good company performance. I want cash flow because that's what pays my bills. Now, I like the idea of owning an apartment building in Redwood City, but I like the idea of owning it forever. And when I'm in this thing with all these other investors and my voting rights are either very low or non-existent, I can't call the shots. And so if they're saying after 8 to 10 years they want to sell it, that's going to trigger a taxable event, and it's going to trigger capital gains. I'm not going to have my cash flow anymore. I'm going to have to redeploy that money. I'm going to have to find another investment, and it just isn't consistent with my investing philosophy. And so for that reason, I tend to stay away from these platforms. Now, these platforms also offer sometimes real estate investment trusts, and oftentimes ones that aren't even publicly traded. But again, I don't identify with those either because the REITs that they offer, it's a similar philosophy. They'll buy properties, they'll hold them for a while, and then they'll sell them. And the REIT that I own, Realty Income, ticker symbol O, the reason I like these guys is, one, I can buy and hold it forever, but they tend to buy and hold forever the real estate that they own. For example, they will work with companies like FedEx. They're a triple net lease company. They'll go to FedEx, they'll say, hey, FedEx, you own all this property, sell it to me. And then what Realty Income does is they lease it back to FedEx. So FedEx, they're not a real estate company. They don't need to own their real estate. And so that helps them out, generates some cash for them that they don't have to, they can extract value from their property, and it puts the real estate in the hands of the company that is a real estate company, Realty Income. So win-win. But Realty Income, they sign these long-term leases. So when FedEx sells the property to Realty Income, they might lock FedEx into a 20 or even 30-year lease. And so again, real long-term. And then Realty Income, they're not looking to sell properties. They're looking to renew these leases. They have very low vacancy rate. And so it's more consistent with my buy and hold forever strategic vision because it's all about cash flow. And the cash flow really compounds in the long term, the buy and hold, the forever part of it. And so again, like these disruptive technologies because they bring opportunities to everyday people, but it's that element of selling the property for a profit just does not work for me. Now, if you are interested in these platforms, one thing to keep in mind is what I found is if you are really serious, you want to go in on an opportunity on one of them, typically the minimums, they're willing to waive or lower them. So I was talking to Realty Mogul about it, the one I was looking at, and they did seem very flexible on the minimum. Oftentimes they're listed at like, hey, 25,000, 50,000. But in the scheme of one's portfolio, you may not want 50,000 in a single property. That may be a little over allocated. And so you can go to these platforms and say, hey, I don't have the 50,000 minimum. Will you let me do it for 10 or for 5? And who knows, 15, whatever, name your number. What I found is they're probably willing to work with you. And so that's something to keep in mind if you are going to go with like a Fundrise or Realty Mogul or one of these types of platforms. Again, I can't guarantee they waive the minimum, but the sense I got is they're probably willing to work with someone, especially if it's a deal that's not already fully subscribed. Okay, so moving on. Great question. I love that one. Again, I'm going a little quicker today just because it's the second time filming this video. Question 4. Hey Ian, I'm wondering, what would change for you should you lose more than 50% of your portfolio value on paper? I talked about this in my last video. If I lose 50%, I'm ready for it. That's just psychologically how I prepare myself for a downturn. Hey, it could happen. Anyways, I've been a subscriber of your channel for long enough to know that you would not sell even if the market dropped 70 or 80%, right? After the last crisis, many people have been calling for a major crash for years, and many of them are waiting on the sidelines with tons of cash. In my opinion, the next crash will surprise and scare everyone with its magnitude or duration or both. Thank you for every minute of your time. Wishing you all the best. Hey, thank you. This is actually a long-term subscriber. I really appreciate this comment. You are the best. Thank you for your support here. It really means the world to me. And so I like this question. Look, no matter how far the market falls, I'm always buying. I'm always buying because the more it falls, the quicker I get to my goal quicker. And the companies that I own, they've been through a lot. A lot of these companies, they've been through the Great Depression. And a lot of these companies, huge decades, track records of raising their dividends. And so anyways, if the market were to crash, I'm just going to keep buying. I just look at it as an opportunity. It gets me closer to my goal because the lower the stock price, the higher my starting yield, more cash flow, retire quicker. Now, most of the companies I own, I don't anticipate that they'll cut dividends. In fact, I think they'll raise them. They may raise them slower if there's a huge economic collapse, but they'll probably raise them just to keep their winning streak going alive. Good example of this, talked about this in the meetup today actually, is a lot of my oil stock holdings, even when oil was down at like 30 bucks and they weren't making a lot of money, they didn't cut the dividends. They held strong because they know how important that is. Oil's recovered a bit. They're real profitable now, and they're doing just fine again. And so, but they didn't cut the dividends, at least the ones I own. Now, let me tell you something. If the stock market does go down, I don't think it's going to go down more than 50%. If it goes down 70 or 80%, the one thing I want to point out is if we're in that situation, we may all have bigger problems here to worry about than dividend stocks. And we may not be even here on YouTube doing this. If the market's down 80%, it might be indicative of something really wacky going on out there in our world, something really unfortunate. But let's say it's down 80% and the world is operating normally as it is now, and things more or less are the same for humans. I certainly would take the opportunity to average down. I'm always buying. Now, one thing I want to say on this point is the question talked about people on the sidelines. The problem with people on the sidelines is they miss opportunities. There's people been on the sidelines for the last 5 years saying the market's going to crash, the market's going to crash. Well, it has not crashed yet. And so these people, they've foregone all these years of deploying capital, of the compounding growth of everything, and they've foregone the ability to build up cash flow. And so for me, I'm always buying because I need to look towards my goal, and I need to just keep building my cash flow. And I generally just like to look at things with an optimistic attitude. Like, yeah, I think there could be a correction coming. Yeah, even a crash. Talked about this before. Link in the description below. But at the same time, I just look at things optimistically. I generally believe that the government, Federal Reserve, the powers that be, they're going to do their best to kind of hold the ship together, to keep it going. There's going to be its ups and downs. There's going to be really big downturns at certain points, but net, long term, up and to the right. And so, given my worldview there, and the fact that, look, that's the world I want to live in. I want to live in a world where things are possible, things are good, there's cash flow, all that good stuff. I mean, if that goes away, hey, like I said, we'll be having a different discussion here on YouTube. And that being said, I generally speaking just try to keep that kind of positive mind state, because that's why have anything else? Why have anything else? I'm real with myself. I realize that, look, my portfolio value could get cut in half. Hey, I'm ready for that, and I look forward to that with open arms. I will buy more stock. But 70 to 80%, that kind of scenario, I don't think that will happen. But like I said, now you know my answer. So really, really great question. Really appreciate it. So moving on to the last question. Question 5. In your portfolio, would you rather have a small amount of stocks that you know for sure are a good buy, 10 to 20 of them, or a much larger amount to get better diversification, but not sure the stocks are a good buy? I really like this question. So I own 40 stocks. Like I talked at the beginning of today's video, I like to buy the ones that are currently on sale. But here's the deal. A lot of you guys are building portfolios now. You're building them. And I've done this before. I'll link in the description below. I've talked about my core, medium, small strategy. This has to be overlaid with value. So if I'm building a new portfolio, and number of stocks, it's generally a function of the amount of money that someone has in the market. Well, small amount of money, you might have 5 stocks. Medium amount of money, 10 or 20. Bigger amount of money, 30 to 40, so on and so forth. And so when someone is just getting started out, you're going to have a universe of stocks that you want to acquire. Generally speaking, at least for me, I go towards the ones that are currently on sale, because I know at a certain point or another, all of them will be on sale. They just won't all be on sale at the same time. So I'm going to buy the ones that are on sale, like I talked about in question 1. That being said, if all of the stocks that are on sale are kind of small bucket, not as important to my portfolio, all the core ones are really expensive, the real important ones, then I start doing things a little bit differently. And I'll tell you, even earlier this year, I was buying Pepsi even when it wasn't on sale. Now it's gone up even more, but like I said, core stock, wanted to focus a little there even though it's not on sale. And so I have to weigh these two things. I have to weigh, look, I want to get to 30, let's say hypothetically I want to get it to from 0 to 30. Totally, I'm going to go for the ones that are on sale. But I'm also going to take those 30, I'm going to bucketize them. Which ones are core to me, which ones are medium, which ones are smaller, in terms of priority, in terms of weight in the portfolio, in terms of how much I want them. If I'm just starting and everything that's on sale is only small bucket, I'm going to look at things a little differently. I'm generally going to start with my core bucket, maybe some of my medium, and so I'm going to look for the stuff that's on sale in those buckets. If nothing's on sale in those buckets, I'll probably just buy what I want, what's most on sale, or what's the fairest value. And so I would have to overlay those two concepts. But eventually I get to my 30, but I wouldn't have to get to that 30 overnight. For example, I would get there over time. I'd build brick by brick. No need for the instant diversification, especially when building from the ground up. Now that I already own 40 stocks, it's so much easier because I already own them, and I just go for what's currently on sale. But not always, I'll tell you. Like I said, earlier this year I was buying I was buying PepsiCo, and I was buying that because number 2 favorite stock of all time, wanted to bring it to size, and so I knew it wasn't a huge bargain, but I did it anyways. And that's kind of that philosophy of core stocks overriding a little bit the value side of things. So it's kind of two concepts that I overlay, and then I use them to drive my judgment. Really good question, and I'll link to that core, medium, small video in the description. It's an older one, so you guys might have not seen it. It was from a while ago. All right, everyone. Thank you so much for watching the video today. I hope this one filmed right. I will see you in the next one. In terms of full disclosure, I am long the stocks mentioned today. I'm long Johnson & Johnson, ticker symbol J&J, McDonald's, ticker symbol MCD, Coca-Cola, ticker symbol KO, PepsiCo, ticker symbol PEP, Realty Income, ticker symbol O, Cedar Fair, ticker symbol FUN, 3M, ticker symbol MMM, Leggett Platt, ticker symbol LEG, General Mills, ticker symbol GIS, Campbell's Soup, ticker symbol CPB, Apple, ticker symbol AAPL, and Starbucks, ticker symbol SBUX. I own all of those in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out, invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally, I'm sharing my journey here on YouTube for your fun and entertainment. All right, everyone, please hit that subscribe button. It would mean the world to me. I love you guys. I will see you in the next dividend investing video. Huge shout out to everyone that made it to the meetup today. I love you guys. Thank you. Let's go, PPC Ian dividend investors. We are strong. We're almost at 30,000. Just around the corner. I'll see you in the next one.